So the first question here is on Bank of America and then CFG, which you mentioned at the beginning. What's the catalyst that's going to move these stocks moving forward?
So in the case of CFG, it's really just execution. And, sometimes it's sort of an interesting thing, and maybe for those who are maybe a little less experienced with, how equities work, maybe I'll just spend 30 seconds kind of doing, like a primer, I guess. There's these two schools of thought. One is that, individual securities are pretty efficient and they price in most of the good news. And then the other school of thought is this idea that, if you have a company that's sort of steadily executing on an improvement plan, and, even if the numbers don't necessarily improve all that much, meaning from an expectation standpoint, simply following through on that execution and achieving those higher numbers that are already anticipated is really going to get you some pretty good appreciation. And in my experience, more times than not, the latter scenario is enough to get the stocks going. And that's exactly what CFG is. So in other words, this is a company, Citizens Financial, where they were basically spun out of Royal Bank of Scotland about 2.5 years ago, and they were overcapitalized, they were inefficient, they had better than average sensitivity to the Fed tightening, and they also had better than average loan growth. So you had this sort of diamond in the rough type institution that had good management, and they knew that all they really needed to do was execute, meaning that if they took their excess capital ratios down by 40 to 50 basis points a year in the form of increased buybacks and dividends, that alone would improve their returns, which they've been doing, and it has. And they were about 500-600 basis points more inefficient than the industry, meaning banks, similarly sized to those over $100 billion in total assets. And think of the efficiency ratio, for those unfamiliar with banks, is simply the number of cents you have to spend to generate a dollar in revenue. So lower efficiency ratios in banking are actually better. So Citizens' efficiency is about 500 basis points worse than the industry. They've been basically on a path of convergence towards that of the industry over the last couple of years. They've been steadily improving that. They reported a few weeks back, and the improvement is ongoing there. And they've got a long way to go, but they've got a very clear plan for how to fix that, and they're executing on that plan. And then, I guess the third and fourth points would be that they've just got an ALCO set up, an asset liability committee set up, where the balance sheet is just more asset sensitive than that appears, meaning that if the Fed does continue to raise rates here at a decent clip, whether it's 50, 75, or 100 bips a year over the next couple of years, these guys are going to benefit more than their peers. And also they're growing loans more quickly. And their credit quality profile is solid. It's right in line with the industry. So there's a lot to like about this company. It's sort of like the little engine that could, I guess. It's just sort of chugging along up the hill. We think it's going to get to the top. And so that's basically the setup on Citizens. B of A is in a slightly different situation. B of A, basically, of course, one of the big uglies. And I guess just to back up a quick step, what I forgot to mention with Citizens is one of the things I pointed out at the very end there on Realogy. Citizens is also a full U.S. taxpayer. It's a regional bank. They don't have foreign subsidiaries that offset their tax base in any meaningful way. And so if there is corporate tax relief at all coming down the pike, Citizens is going to be a disproportionate beneficiary. And the reason I bring that up is because, unlike Citizens, B of A is a global money center bank and does benefit from foreign tax benefits. And so the fact that they have that benefit already is going to dilute some of the benefit that would come down the pike. The other thing to understand about these big sort of money center banking complexes like B of A is that they are lower relative beneficiaries of the Fed raising rates. And the reason why is a pretty simple one. Yes, you can look at, in the industry, it's what's called one-year static gaps. It's basically the net percentage of their assets that reprice relative to their liabilities. In other words, how quickly does the balance sheet reprice as the Fed raises rates? And they're fine there. They actually look a lot like the industry. But the point is that because they do all these other things, net interest income is actually a much lower percentage of revenue at a large bank, at a large money center bank, than it is at a regional bank. So to give you sort of the difference, B of A derives roughly 51-52% of its revenue from net interest income, whereas Citizens is around 73%. So in other words, every time the Fed raises rates, Citizens is going to make an extra almost $50 million in pre-tax income, whereas for B of A, it's a much smaller driver than it is at Citizens. So anyway, they have less benefit on the margin side, and they have less benefit potential on the tax side. And then outside of that, B of A specifically just lost a pretty big court case, actually before the Supreme Court. Literally, this came out yesterday or the day before, where the city of Miami had been suing Bank of America. Essentially, it's a complicated case, but to give you sort of quick background for those who are interested, if you went back to the sort of 1960s, I mean a long time ago, banks got in a lot of trouble because they were basically discriminating with respect to making loans to individual borrowers and to business borrowers. And what they would do is they would have a map, and they would basically draw a red line around the map in an area of the sort of city where they didn't want to make loans. And it was called redlining. There'd be a red line around this segment of the map that we don't lend to. And it became illegal. And fast forward, 45 years, and you've got a whole new issue, which is called reverse redlining. And this is basically something the cities, some cities of America, Miami sort of being the most prominent here, have alleged these large banks to have engaged in. And what does that mean? It means that the city of Miami alleged that Bank of America, among others, extended too much credit into those so-called red line areas. And as a result, in other words, they lent money to people who they could reasonably have expected not to be able to repay the loan. And as a result, you ended up with numerous foreclosures and blight, and lost, really what they care about is lost property tax revenue collections. And so they filed suit, Miami did, a number of years ago, and it sort of worked its way through the courts, and ultimately the Supreme Court came in a couple days ago here and said, essentially ruled 5-3 in favor of Miami, and said that in fact Miami is allowed to sue Bank of America over this so-called reverse redlining. The question, though, going into the ruling was, how much liability are we talking about here? And what we sort of learned in conjunction with the ruling is that the Supreme Court set a very high bar for the requirement of proof that would be needed in order to establish both sort of cause and damages, meaning that, okay, so now the cities can sue the big banks over this issue, but it's going to be the rules and requirements are going to be very strict, meaning that they have to really prove to a very high degree that this lost tax revenue was a direct result of these banks' activities, which is going to be expensive, time-consuming, and probably is ultimately going to limit the damage from this to something that's pretty manageable. That being said, these big banks have forever been unable to get out of their own way for one reason after another ever since the Great Recession. And so this is just sort of the latest iteration on this sort of ongoing trend. And then I guess the only other thing I would say on B of A is that, there was talk, chatter, is a better way of putting it, out of the administration, I think specifically out of President Trump, the other day talking about this idea of breaking up the big banks. I think he said something along the lines of bringing back Glass-Steagall. And all I can say is that, maybe even take a step back here, frankly, the markets got it so wrong with respect to the election. The consensus was that Hillary was going to win, and that Hillary would be better for markets. And then, obviously, Trump won, and Trump turned out to be, at least from a perception standpoint, very good for markets. And I would argue that a nearly identical misperception exists right now around this idea of breaking up the big banks, meaning that, the average person out there thinks, well, I should say the average investor out there thinks that that would be this terrible thing for these large institutions were they to be forced to be broken up. It is so wrong. If these banks were broken up, the amount of regulatory supervision, capital requirements, numerous things about them would improve dramatically. There is no question that if you valued each component of these large banks on a standalone basis and added them all up, aka a sum of the parts valuation, you would arrive at a much, much higher value than where they're trading now. There is a massive conglomerate discount embedded into all of these big money center banks. And so, anyway, if we ever do go down that path, and I don't know probabilistically whether that's likely or not, because that's a pretty tall order here, especially with all the other things on the table, but if we ever do go down that path, it would be an incredibly, profoundly positive development, and these stocks would be worth a lot more than they're worth right now, or I should say these companies, and the stock prices would reflect that. So anyway, those are some of my thoughts on B of A.
Yeah, and probably obvious, but you're obviously talking about like the brokerage house and investment banking side of these businesses.
Yeah, well, I'm basically saying that if you strip up the component parts and look at those on a standalone basis relative to their peer groups, every single one of them would suddenly be the cheapest in the entire category.